Hello everyone. I want to walk through capital asset pricing models today, or one model. And it sounds more complicated than it is. This is a way to find, if you're a CFO, it's a way to find the cost of your equity, or one way to find the cost of the equity. If you're an investor or if you're a market analyst, this is really a way to see what is the market requirement as far as return on equity, with risk being a factor. Okay, so again, these videos never replace actually reading the book, but what I'm going to do is show you the mechanics of how to do this. I'm not going to get into the philosophical differences and concepts concerning market risk premium or beta, but just that they exist, and we'll walk through a couple of the basic pieces we get through the formula. But again, this is the capital asset pricing model to find the cost of equity that you'll use a lot of times to figure out your weighted average cost of capital, which is the basis of many conversations and formulas for financial decision making. So let's get into how this works. Let's assume that we are looking to see what's the cost of equity. What are investors requiring as far as return in the context of risk in an equity investment? So let's say that there's a risk-free rate, which is typically given when working with the CAPM models, of 6.5%. Okay, and again, I'm using this box which I've created to organize our conversation today, but there's the formula that I'm using. It's not too awful difficult to recreate this. Or leave it in the comments, give me your email address or whatever, and I'll email it to you. That's not a problem. So we're using this formula, but it's really more about organizing the information than any. So the market risk premium, here's where people mess up all the time. I'm going to go ahead and give you the market risk premium, which is 7%. But one thing that people need to understand is that the market risk premium normally has to be calculated as opposed to given to you. So in the real world, if we wanted to know the market risk premium, we would look at the required return on the market, which a lot of books or publications designate as R lowercase m, or subscript m. That's the required return of the market, minus the risk-free rate, right? So if the whole market requires 13.5% and our risk-free rate is 6.5%, that tells us that at that point in time, investors in the market of risky assets or investments are demanding at least or on average 7%. So the market rate of 13.5% minus a risk-free rate of 6.5% in this case gives us a market risk premium of 7%. Now, beta is a measurement of how risky an asset is, or how risky an investment is in the context of the market, right? So beta looks at basically if the market moves X amount, beta moves Y, right? So it tracks the movement of the market, and we use beta as a measure of risk in the context of volatility, right? So beta can show movement up and down as far as in the context of the market. So if we had two different charts and showed a high beta investment, it might look something like this as we go through time, whereas a market may show a more smooth upward incline. So that would be a highly risky, highly volatile investment. Enough on beta. What it is can be seen or heard in a million different videos or read in a million different books or publications. But in this case, we have a beta of 0.8, less than 1, right? So this thing moves less than the market, or it's less volatile than the market. When the market moves 1 or has a slope of 1, the beta has a slope of 0.8. So if we use this, we can see that the risk-free rate is 6.5%. That's given. The market risk premium is 7%. That's also given. Those together show us that the market risk, or the overall required return of the market, is 13.5%. 0.5%. Now the beta is a multiple in determining the risk, so that it's the beta times the market risk premium to show the risk of the investment, which in this case gives us a total cost or a total required rate of return of 12.1%. I hope this was helpful. Thanks.